For 5 years, YouTube gurus sold you a dream. Buy a house, put it on Airbnb, retire in 30 days. It was the passive income gold rush. Teachers, dentists, and Uber drivers levered up to buy second, third, and fourth homes. They didn't buy them to live in. They bought them to run unregulated hotels. But in 2026, the party is over. The Airbnb bust is real. Bookings are down, supply is up 100% in some cities, and those passive income properties are now active liabilities. Thousands of amateur landlords are realizing they can't pay the mortgage. But here's the twist. When they sell, who is buying? It isn't families, it's Wall Street. We are watching a transfer of housing stock from the middle-class speculator to the corporate lord. The crash is happening, but it's happening in the shadows. Let's look at the math of the short-term rental STR bubble. In cities like Austin, Phoenix, and Nashville, there are more Airbnbs than hotel rooms. This is hypersaturation. When supply doubles and demand stays flat, prices crash. Hosts who budgeted for $300 a night are now fighting for $100 a night, but their mortgage is based on the $300 math. This creates negative cash flow. Every month, the house eats money, and these loans aren't 30-year fixed rates. Many are DSCR loans, debt service coverage ratio, or variable rate products. When the income drops, the loan technically defaults. This is a ticking time bomb of forced selling that Zillow isn't showing you yet. Why aren't we seeing a price crash yet? Because of phantom inventory. Failed Airbnb hosts are trying to hold on. They are pivoting to midterm rentals or long-term rentals. They are flooding the rental market, driving down rents for everyone. But eventually they have to sell. When they do, they often sell off-market to cash buyers to avoid the embarrassment of a public listing. The cash buyers are the institutional investors. The transaction happens in the dark. The house moves from an individual to a corporation without ever hitting the MLS, multiple listing service. This hides the true volume of distress from the public data. Who is on the other side of the trade? Enter the corporate landlord. Blackstone, Invitation Homes, Pretium, American Homes for Rent. They have a new strategy, build to rent, BTR. Instead of fighting you for old houses, they are building entire neighborhoods that cannot be bought. You drive past a new subdivision. It looks like the American dream. Picket fences, lawns. But there is no sales office, only a leasing office. Every single home is owned by a hedge fund. They are industrializing the landlord business. They use AI to set rents, maximizing what you can pay. They use economies of scale to cut maintenance. They are turning housing into a subscription service. Why do they want to own all the houses? Because of the yield delusion. In a world of high inflation, episode 03, smart money wants assets that can reprice annually. A bond pays a fixed 4%. Inflation eats it. A rental lease resets every year. If inflation goes up 10%, the corporate landlord raises rent 10%. Housing is the ultimate inflation-protected bond, and unlike a bond, you can't default on your need for shelter. You have to live somewhere. They are betting that homeownership will become a luxury good, available only to the top 10%. Everyone else will be a tenant in the neo-feudal system. But here's the risk. Many of these investors, both amateur and corporate, bought at the absolute peak in 2022-2023. They paid 50% over asking price. Now, values are softening in real terms. If you put 20% down and the house drops 20%, your equity is wiped out. You are underwater. For a homeowner, this is bad. For an investor, this is fatal. Investors walk away from underwater properties faster than homeowners do. This is the negative equity contagion. If the Airbnb bust forces a wave of selling, it drags down the comps, comparable sales, for the entire neighborhood. Your house is worth less because your neighbor tried to be a hotelier and failed. This isn't happening everywhere equally. It is concentrated in the Zoom towns, Austin, Boise, Phoenix, Nashville, Florida. These are the places where prices doubled in 3 years because of remote work and speculation. They are the most vulnerable. If you live in these markets, watch the days on market, watch the price cuts. When you see furniture included in a listing, that is a failed Airbnb host trying to exit. That is the smell of blood in the water. Smart money is avoiding these markets right now, waiting for the capitulation. Let's summarize the investigation. The housing market is splitting. The owner market is frozen. The speculator market is crashing. The Smart Money Playbook. 1. Don't catch the Airbnb knife. If you are looking to buy, wait. The supply from failed hosts hasn't fully hit the market yet. Wait for the foreclosure auctions. 2. Avoid the build-to-rent trap. Don't buy a house in a neighborhood dominated by rentals. Your property value will be capped by their business model. 3. Look for the user market. Buy in boring, established neighborhoods where people actually live, not vacation. Stability over hype. 4. Watch the institutional flows. If Blackstone starts selling, like they did in 2024, it's time to worry. If they start buying, the bottom is in. The American dream is being privatized. To keep yours, you have to navigate the minefield. This is the Smart Money Wisdoms. The future belongs to the owners. Thanks for watching. Like and subscribe. See you next time.